All of the details we provide is actual client data with only the client names changed. While the client assumptions and the projected outcomes at a 20-year mark are shown, as well as the starting data, the actual work product with annual details cannot be shared until such time as we're engaged for services. In case study number 1, we have John and Linda. Over 20 years, we were able to demonstrate a reduction of their income tax bill by over 30%. For the background on this case, John is age 66, still working with a plan to retire at age 70. Linda is 61 and is recently retired. They have a combined $520,000 in IRA assets. They also have rental real estate that they're selling, and they expect to realize $175,000 from that sale after taxes. In addition to the IRA and the real estate for sale, they have another $68,000 in taxable accounts. All of the plans that we create include cash flow needs, which are typically inconsistent on an annual basis, as we, as spenders, typically never spend the same amount each and every year, even considering inflation. There might be big-ticket items that change the annual budget, such as a boat, motorhome, wedding gift for a child or grandchild, automobile, or such, and we have the ability to account for those inconsistencies. There might also be cash inflows to consider, such as an inheritance or sale of real property. We factor in inflation, which can vary for each category of spending, an amount that's agreed to by the client. We also use earnings assumptions in our plan as agreed to and provided by the client. For this client, the household budget for health insurance until Linda reaches age 65 is $13,200. Effectively, it should adjust down at Medicare age of 65, but because of their chosen inflation rate for medical, on this plan it doesn't appear to. This is a modest couple with a paid-off house, believing that they need just $45,500 a year to live on, plus another $3,600 a year for travel. This couple prefers us to use a 3.25% inflation rate, and the travel for them will stop after 20 years. Other than lifestyle, healthcare, and travel for 20 years, the only other budgetary need is a new vehicle in the house. Every 5 years, they rotate out and get a new car, and they plan to trade in their car, the next one being in 2020. They expect to pay a very modest $15,000 in today's dollars over and above their trade-in value every 5 years, using that 3.25% inflation rate. Please note, all of these amounts are as applied to by the client. On their investment accounts, these clients desire to use a 7% average earning rates on IRAs and Roth IRAs and a slightly lower 6% rate on taxable investment accounts. It's not unusual to use a slightly lower rate on taxable accounts because these accounts tend to be invested more conservatively. To help offset their budgetary needs at the age of 70, John is expecting $39,000 a year of Social Security income using a 2.5% inflationary increase on that number. However, based on our recommendation, he was able to file a spousal benefit beginning in August 2019, and collect $1,248 a month. He'll still get deferral credits on his own benefit until the age of 70. Because he was born before January 1954, that allows him this special treatment. His wife, in the meantime, will also be collecting her benefit of $28,840 a year, beginning in the same month, August of 2019. By the way, this portion of the Social Security planning, it's part of our services as we integrate Social Security into the tax plan. Over the next 20 years, our recommended strategies would save John and Linda just shy of $70,000 in income taxes. While the $70,000 is saved over 20 years in this plan, more of the taxes are indeed actually being paid up front in our proposition. So in fairness, we should indeed question how this upfront payment of taxes would impact their wealth on a long-term basis. Beyond how much taxes are paid, a greater emphasis in our plan is placed on the wealth analysis. But to us, just as important as reviewing gross wealth, we believe it's also important, if not more so, to analyze the net wealth. By net wealth, we're referencing not just the amount in the IRA accounts that you get to see on your statement, but the amount of money that's truly yours and your family gets to keep and utilize after paying off the mortgage to the IRS on those accounts. To analyze that, we have to assume that a certain portion of your IRAs and other qualified accounts will be lost funds to income taxes, either by you at some point or ultimately by your heirs. Based on the assumptions used, at the end of 20 years, if John and Linda followed our proposed strategies, their gross wealth would actually decline by approximately $42,000. But if we assume a 25% mortgage on the IRA assets, their net wealth would have increased by approximately $200,000. There's probably a better way of evaluation to look at this benefit. On the gross wealth side, before considering any built-in liability or mortgage, the question that I'd pose to you is, would you sacrifice $950,000 of IRA assets, which would be subject to the tax on distribution, subject to required minimum distributions, and would you also sacrifice another $750,000 in your taxable accounts, where the growth that you earn is taxed each and every year, if we were able to replace that with $1,650,000 in a Roth account, never to be taxed during your lifetime, nor the lifetime of your heirs, again? If you feel that that question needs additional consideration or thought, please pause the video right here and give it some thought, or rewind it a little bit and listen to it once more. Here's a second way to evaluate the trade-offs that are presented. The top 5 rows in this graph reflect data on a gross basis, and the bottom 5 rows on a net basis, which is assuming a 25% mortgage or liability on the IRA. If we compare the current column versus the proposed column, and the proposed plan, we would have sacrificed $751,000 in the taxable account, and we would also have given up $957,000 in the IRA on a gross basis for a combined sacrifice in those two accounts of just over $1.7 million in wealth. However, in the proposed plan, we would have gained $1,666,000 and change in the Roth IRA. That effectively means we were able to transfer 97.5% of our gross wealth from the IRA and the taxable account into the Roth IRA. Translated, that means our cost of the transfer, net of all taxes paid, was 2.5% after 20 years' time. If I were to suggest that you could realign your wealth into a Roth IRA, and after 20 years the cost for this realignment was only 2.5%, would that be attractive to you? If you understand the value of the Roth, if you've watched my dollar double presentation, the extended one, you understand that this question is rhetorical. If we did the same review and we look at it on a net basis, meaning that we assume that you own 75% of your IRA and Uncle Sam owns 25% of your IRA, so we're only looking at your 75% that you own. The 25% that you don't own is the mortgage portion of your IRA or the tax liability that's embedded in your account. If we use that assumption in net wealth terms, the portion of the IRA that truly belongs to you, you really only sacrifice $670,000 of your portion of IRA assets, in addition to the $750,000 of taxable assets. Meaning on a net basis, those two reductions are $1,420,000. But in exchange, if you had $1,666,000 in your Roth IRA, the Roth IRA would represent 117% of the value decline of the other two accounts. So in essence, the government paid you 17% to prepay your mortgage. I could ask the question if that would be attractive to you. For this couple, we did not recommend a Roth conversion of 100% of the IRA. At the end of the 20 years, we would still have a value in the IRA of about $176,000. That's because for this couple, at the end of the 20 years, they could still take required minimum distributions on the $176,000 and be in a zero tax bracket. After our initial strategies are implemented, this couple would pay zero federal taxes, and depending on their state of residence, zero state taxes as well. So for this couple, let's look at the evaluation for their heirs. Since the heirs under present law can stretch IRAs and Roth IRAs over their lifetime, that means that there's a continued tax benefit while distributions are allowed to be deferred on a continued basis. If we wanted to analyze the value of the two scenarios, current versus proposed for heirs, we need to make certain assumptions. In this case, based on their kids' ages, we assume the distribution period for the heirs is 36 years. In order to compare the two options, we want to assume that the heirs only take distributions that are required, and they reinvest them in a taxable account to be left behind for a third generation. The residual value to the third generation, after growth and taxation of column A, over a 36-year distribution period is $14 million in the current plan. And in the proposed plan, column B, the value over that same 36-year distribution period is $28 million, which represents a 100% increase in wealth for the heirs. But a tax-free Roth account provides complete financial freedom, which is why we call it the Advanced Financial Freedom Plan. You need to understand that you can take as much out of the Roth anytime you want to without any concern of taxation. You can purchase a $1 million chalet in France and not pay any taxes on the Roth distribution to buy it. Or you can buy a condo in Vegas or a Lamborghini out of the account and have zero tax consequences. Can you imagine having to take $150,000 out of your IRA because you wanted to buy a condo as a second home, and then having a $60,000 or $70,000 tax bill next April, effectively increasing the cost of what it is you wanted to buy by 40%? Versus if it's in the Roth account and you take the money out tax-free. Or imagine if your child or grandchild got in trouble and you needed to take $50,000, $75,000, or $100,000 out of your IRA, and then have the tax bill that came with that the next year to help your child out, versus it being a Roth IRA and you just take it out of the Roth. You have the financial freedom to do that without worry of taxation. If you want to help your grandchild with college expenses, you get the point. Again, that's exactly why we call it the Advanced Financial Freedom Plan, using advanced tax strategies to gain financial freedom for you. We'd be happy to discuss this and the value of the stretch laws in the free consultation on the phone that we offer with you. Please schedule a call with the tax planners now and let us discover ways to maximize your net wealth through our strategic tax planning. With our money-back guarantee, what do you have to lose? Start your Advanced Financial Freedom Plan with us today. I'll close this presentation with a few myths. Myth number 1, taxes do not have a dramatic impact on your wealth. Well, I could assure you and demonstrate to you that they do. Myth number 2, there is nothing I can do about income taxes. That's a complete myth. Absolutely, positively, there is something you can do about income taxes. Myth number 3, I'll be in a lower tax bracket in retirement. That is a myth for most of the people that we meet. Not most of those people are in a lower tax bracket. Some of them are in a higher tax bracket because of the double taxation that I talked about earlier. And myth number 4, save in your 401k. Well, actually, I want to encourage you to teach your children that might want to save in their 401k. But they want to have an Advanced Financial Freedom Plan when they start hitting their mid to late 50s, so that when they get to retirement, they can learn how to turn the table on the IRS before it's too late. So please give us a call and let us help you discover ways that we can help you with your planning, more specifically your tax planning, today. Thank you.